to Peachtree Point of View with Greg Friedman, the podcast that shares insights and strategies to navigate dislocated markets and capitalize on mispriced risk.
This is Greg Friedman, Peachtree Group. Tax efficiency is something that I think a lot of times is underappreciated, just given the fact that it can, in a lot of cases, drive 200 to 600 basis points of IRR on these alternative investments that we make. So when you put math to it, in a lot of cases, it could actually improve the actual returns you're receiving on your investment by, 20 to 50% in many cases, depending on the type of product you're investing, if it's credit or equity. I'm fortunate to be joined with four different individuals: Ari Lasky, Isaac Weinberger, Dan Bergan, and Tim Witt. To start out, I'll let Isaac and Ari give their background, and they're going to focus on the bonus depreciation side. And I'll have then Dan give an introduction, as well as Tim Witt. And Dan's going to talk about PPLI, and Tim Witt will be speaking more about QOZs and DSTs, as well as Roth IRA conversions. But before we get into that, I'll let Isaac and Ari give an introduction.
Yeah, thank you so much, Greg. I'll start and then I'll introduce Ari, take over. So first of all, thank you so much, Greg, and the greater Peachtree Group for inviting us on. I always like to start is that I always found it extremely interesting. You have principals of firms, you have investors that will sit to the wee hours of the morning negotiating with their investment sales guys and the brokers, trying to get a better deal. And they'll work on the financials and do so many different things just to get a better deal and save $1 here and $1 there, which I love. I think that's cool. But when it comes to tax efficiency, when it comes to saving real dollars, we're talking about potentially millions of dollars sometimes. There's so many people that are uneducated about it. And one of the things that I do, and even with sophisticated firms, is really break it down in terms of, are we maximizing it? And I could say that Peachtree as a group has done that. They really have their ducks in a row in terms of really maximizing every single dollar that they can hand off to either themselves or their investors or both. And that being said, cost segregation, the concept of cost segregation is known, but many people misunderstand it. There's many, many misconceptions about it. And not in a complicated way. I just want to break it down for a few minutes and how it plays out and just give like a quick case study. The example I always like to give, just very simply put, if I owed you $100 and offered to pay you either $10 a year for the next 10 years or $30 year one and $70 over the remaining 9 years, every year broken down a little bit. Obviously, you would take more dollars up front. You probably want everything up front, but if that's not an option, you would take as much as you can up front, because we all know that time value money is valuable, right? Time value money, $1 today is worth more than $1 tomorrow. So if somebody goes ahead and he buys, I'll use an example of a $100 million asset. He buys a $100 million asset, the development, let's talk about development. So there's no land cost. He spent $100 million on hard and soft costs, and we're going to get back through a cost segregation study, $30 million year one. That's what we're able to reclassify. We're able to segregate out the non-structural items, and we can give you more depreciation up front. That's $30 million of tax deductions year one that can be handed off to the partners, that can be handed off to investors. And if you would do regular depreciation, you would get much less. We're talking about that $100 million would be divided over 39 years when it comes to commercial real estate. So we're talking about a fraction of that amount year one. Now, again, I'm not getting you more depreciation, but it's a time value money play. When you go and you have a conversation with an investor, you can go ahead and know when you write out that check to Greg and his firm, you really can go ahead and potentially write out a larger check, because you're not really all in for what you think you're all in for. If you're writing out $1 million check and you're going to get $1 million back in tax deductions, because let's go back to my example for a second. If we find $30 million year one of the $100 million development, what's going to happen is, and the equity in that deal was $30 million, that's dollar for dollar. So if you're investing $1 million, you're going to get back $1 million in tax deductions. So say you're in the 30% bracket. So that's basically worth more than $300,000 to you. So $300,000 in real time money, you're really all in for $700,000. So you might not want to invest more in that deal, but it's just good for you to have in your mind. You're not really all in for that $1 million check. And also for the syndicator, for the group that's raising the money. It's just a good way to have these conversations. Nobody's going to invest in the deal for depreciation alone, but these items are so valuable and people don't give them enough attention. I can't tell you how many times I speak to sophisticated owners that just never did it for no good reason. Sometimes there are good reasons not to do it. You're selling the property too fast, and you will get hit with recapture. Recapture means that the tax deductions you took today will come back to you at the time of sale unless you 1031 exchange it. But even if the deductions will come back to you and will be added back to your income, again, would you rather pay your tax liability today or pay it tomorrow? If you pay it tomorrow, you have access to this cash today to go ahead and reinvest in another deal. So the idea is, again, simply time value money. And I could go on for 5 hours about why it's worth it, even if you're going to sell it next year, because the capital gains, when you get hit with the recapture, it's recaptured at a lower rate than when you initially take it. You can go ahead and offset ordinary income. There's conversations to be had, and we can have that for dates. But just simply put, and not to go ahead and confuse you, cost segregation, simply put, is I'm accelerating some of my own depreciation by reclassifying assets, reclassifying components within the actual structure of the property, enabling me to take larger tax deductions earlier on, offsetting NOI, offsetting investor capital, higher returns, like Greg had mentioned. So this is something that people are not taking advantage enough of. People are getting educated, they are learning. And again, when I speak on any given day to an investor and then I speak to an operator, speak to the owner, people are taken aback about the leverage that it gives them. And this is how the rich get richer. I'll just end with this. Just something funny. Trump said a few years ago that he paid $750 in taxes. And everybody said, oh, another Trump scandal. And the funny question I had was, why'd you even pay $750? You got 1031s and you got cost seg. Don't pay $1. You own real estate, buy enough real estate. You're a real estate professional. Again, it's another conversation. We got to make sure that your structure fits it. But many people can fit into the right structure, especially if you're investing and buying a lot of real estate. That's what I would say. And again, just to remind ourselves, and that $100 million development example, we're talking about dollar for dollar. We find 30 million and the equity is 30 million. So we're talking about 30% of what you invested in, technically, you really have in your pocket as you would have given to the IRS 4 months down the line. Greg, if you want to address any other points about cost seg, let me know.
Yeah, Isaac, I think that's a lot of good information, and just taking a step back to simplify it and make sure everyone understands, because I do think this is very powerful, like the bonus depreciation, and with the big beautiful tax bill that was passed recently, effectively brought bonus depreciation back, where you had 100%. So effectively, when you build, for instance, like a new hotel, just based on the cost seg studies we've seen, it seems like on average about 30% of the total project cost qualifies as 100% bonus depreciation. So in your example where you build it for 100 million, technically $30 million of that, project costs should have 100% bonus depreciation, year one that the property is open and operations, right? Like you would get that benefit. And if you're getting 70% financing, and you're putting in 30% equity. So if you're 100% of the equity in that project and you're the developer of that hotel and you just put up all the capital yourself, you're investing 30 million of cash. But year one, when the property opens, you're getting a $30 million effective, assuming you're a real estate professional, you get 100% write-off, right? On the active side, or even as against passive losses. So effectively, that's how you're getting back, through tax savings, 30, 40% of your investment effectively through the bonus depreciation. Is that the right way to sort of look at it?
Exactly. You said it very well.
I mean, you still have recapture down the road, something that investors should think about, but it's something that you can deal with through potentially opportunity zones and 1031 exchanges, which we'll talk about shortly. From your perspective, have you seen anyone utilize bonus depreciation uniquely with 1031s and opportunity zones, or is it just totally independent?
No, absolutely. And I do want to bring Ari in over here, but I just want to say something to add on to something you had mentioned, that just like a 1031 exchange, you get to roll over and kick the can down the road so long that you keep exchanging the property. But eventually, if you sell that property and you don't exchange it, you're going to have to pay the capital gains. And that's why we all know the terminology of swap until you drop, right? And the idea is kick the can down the road. But the only reason why people don't do 1031s is that they have a hard time identifying and they get pressured and by a bad deal. But I haven't heard too many people say kicking the can down the road isn't a good idea. It's the same thing with a cost seg. The idea is, yes, you will get hit with depreciation recapture. But again, look at yourself in the mirror and say, hey, would I rather pay my tax liability today or would I rather pay it in 5 years? Now, if you know that your tax bracket's going to go up like tremendously, that's a different conversation. But if it's not going to do that, you got to crunch the numbers and realize how valuable is it to have this extra cash in my pocket today. That being said, I do want to introduce Ari. Ari is the lead CPA at Madison Specs. He's seeing the implementation of tens of thousands of cost segregation studies. He doesn't like when I say it, but he's a smart cookie. And Ari, maybe you could just give some insight again, maybe for a minute about Madison Specs, but then about 1031s and opportunity zones, how it plays together.
Yeah, I mean, I can't really add much more to what Isaac already said. He really nailed it on this. I do want to, and I'm sure everybody on this panel would agree with me, that we don't necessarily want the tax tail to wag the investment dog. We're not chasing after deals just for the tax incentives. But assuming that you have a good deal, and Isaac really hammered this home, assuming you have a good deal, it's foolish not to look at the tax implication. Kind of what Isaac was saying before. We scrutinize every line item on that P&L, making sure the utility costs aren't too high, and turnover rates and construction costs, and we're really scrutinizing all these line items. But oftentimes we're forgetting our biggest line item, which is the tax liability. So not taking the tax incentives into consideration is just missing one of the biggest line items on your P&L on your eventual tax return. So yeah, absolutely worthwhile looking at that. In regards to cost segregation, 1031s, DSTs, opportunity zones. I mean, these are all great strategies as standalone strategies. But really, when you combine them together, it really becomes a powerhouse of tax incentives. Whereas you could buy the property today, do a cost segregation study, get all that deduction upfront. And as Isaac was alluding to, usually when you sell that property, you're going to be hammered with a large capital gains tax, depreciation recapture tax. So although we did defer the taxes, which in itself is a big benefit and definitely worthwhile, eventually 5, 6, 7 years down the line, you sell that property, you're going to have to pay the taxes at that point. But when you combine a cost segregation study with a 1031 exchange, a DST, opportunity zone, other strategies like this, then the power of the cost segregation study just gets compounded by how much longer you could sort of say, kick this can down the road, let your money build for you, time value money. I mean, it's just an overpowered strategy.
I guess, Ari, for you, before we jump to Tim Witt, if you're an investor, like going back to that example where it's that $100 million hotel property, you need to inject 30 million of equity. I talk to a lot of different, investors, and a lot of times they're looking for their own project because they feel like, hey, I'm going to, maybe I don't have the experience and knowledge, but I'm going to stretch in order to get the tax benefit. But do you need to be the sole owner of the property in order to get the benefit of bonus depreciation, or can you invest through a partnership with another group and still get the benefit of bonus depreciation and so forth through a partnership or a private placement?
Sure. That's a great question. And the answer is really going to depend on the individual situation. So, when we're going to get involved with active participation, passive losses versus active losses, that could be a very, very complex situation. Everybody would have to check with their own personal tax advisor to make sure the situation is right for them. But, just to simply answer your question, no, it doesn't really matter. Bonus depreciation, depending on the situation and flow through, the individual, the investor, whether you're actively managing a GP, LP, they're all going to benefit from that flow through of that bonus depreciation down to the individual level via the K1 or Schedule C, Schedule E, however they own it. That bonus depreciation is going to be available and useful to them. Exactly how it's going to be, that's really going to depend on their situation, real estate professional status versus passive investors. That's all going to be treated slightly different, and that's a much larger conversation.
And just to add, you could always offset passive with passive. So even if you're not a real estate professional, if you have passive income, you can use these passive losses to offset that.
Yeah. And I think as we move to Tim, one just takeaway I think that y'all nailed, the most critical thing when making an investment, make sure you're making it in a good investment, and you're better off investing with someone that's got experience, knowledge. You're better off making sure you have a, great investment, and by layering in and getting the benefit of bonus depreciation is just going to make it that much more compelling of an investment, because again, bonus depreciation can really drive returns depending on the type of property you're buying. And one thing we didn't cover, bonus depreciation can be higher if you're buying certain properties, like you're buying a convenience store that's got gas, or in the case of like a car wash, for instance. If you have additional questions on bonus depreciation, please, we have a chat box too. You can put questions into today and we'll try to address some of them at the end. But also, Ari and Isaac would always be happy to answer. And they're a huge resource for Peachtree because we utilize them for our cost seg studies and for our strategies around maximizing and optimizing for bonus depreciation across our projects. With that, I guess, Tim, Witt, maybe if you could talk a little bit about just quickly your background, but also about 1031 DSTs, because that's a market that you're very knowledgeable on. And let's start there, and then let's talk about QOZs, qualified opportunity zones, and Roth IRA conversion strategies as well.
Sure, and thanks for having me on today. Again, my name is Tim Witt. I run Peachtree's DST program, and I help out with all of our tax strategies. And I'll talk about what a DST is more in a minute. But the DSTs were blessed by the IRS back in 2004, and I've been around DSTs since that time, and at 1031s and alternative investments. But I always start talking about what is a 1031 exchange. I find a lot of people heard of it, know it's something to do with the real estate, but not really sure what it is. And 1031 refers to Section 1031 of the tax code. And under 1031, an investor can sell an investment property, take those proceeds, and reinvest it in another investment property, and defer all the taxes associated with the sale of that first property. That includes capital gains tax, depreciation recapture, which we've already talked about, which can be at 25%, as well as state taxes can make a big difference whether you live in Florida versus California versus New York. But what we find is a lot of investors, when you add all those up together, they may have a tax liability of 30, 35, 40% is not uncommon. It's oftentimes well in excess of just the long-term capital gains tax rate. It's such a powerful tool because if you're going to sell a property and buy another property and not do a 1031, you're going to sell your first property, then you're going to take some chunk of that money, give it to the government. It's not available for reinvestment, then you're going to reinvest a lower amount than what you had originally. With 1031, everything gets reinvested. There's no leakage of dollars going to the government in that transaction. So super powerful tool to continue to build wealth without having to give the government a chunk every time you sell a property. And there's no limit to the number of times that you can do a 1031 exchange. And so most investors, they'll 1031, 1031, 1031, and so forth until they die. Then their heirs will get the stepped up basis. And now the deferral becomes a permanent elimination upon death. So super powerful tool for investors to use. Now let's talk about what DST, and DST stands for Delaware Statutory Trust. And a DST works for 1031 exchange, and you can't exchange into, I'm not going to go to all the rules and regs around 1031 exchanges, but let me say one thing though. If you're planning on doing a 1031, you're thinking about 1031, make sure you get everything set up before you sell your property. If you wait till after you sell your property, you're going to be too late. So that much, don't forget that, that part. And you can always Google all the, the IRS rules and regs and safe harbor that you have to follow to do a full and complete deferral. But with a DST, you can exchange into real property, into investment property, and a DST, and then you can't exchange into a partnership. You can't exchange into an LLC with a bunch of other passive investors, but you can exchange into a DST, even though it kind of looks and operates kind of like a partnership. There's a revenue ruling back from 2004, and IRS says, well, if you follow these guidelines, a DST, investment in DST will qualify as real property for completing a like-kind exchange. And so a DST, it's a trust that's created. The trust acquires a property, and typically a property is going to be in the range of $25 to $100 million. It could be a hotel, it could be an industrial property, it could be apartments, self-storage, and so forth. An investor can make a fractional purchase in that DST, and that qualifies as replacement property. And it works so well for an investor. It works really well for investors at the point in their life when they want to go from active ownership of real estate to passive ownership based on age, health, lifestyle choices, but they don't want to have a big tax bill while they're making a transition. DST is completely passive investment. So you may invest $100,000, you may invest $1 million into that DST. You get you're going to get distribution once a month from the sponsor like Peachtree. You'll get quarterly reports, annual tax statements, but nothing that you have to do to hands-on manage the real estate. These are investors are saying, hey, I'm tired of what we call the T's, the tenants, toilets, and trash. They just want to get out of all the hassles of managing and go into a passive investment. And the DST works extremely well for that type of investor.
So effectively, I could sell a duplex that I've owned for many years and been just, utilizing as a rental property or rental property investment, and then turn around and instead of going and 1030, trying to find something of similar size, so I sell a duplex for $1 million and assume I had no debt on it. Normally I would, sell it and I would have to, if I'm going to do a 1031, I got to go find a like-kind property of similar value to buy. But in the case of DSTs, I can effectively now just go buy. I could invest into the trust that could buy, and it could buy like a large industrial property, or it could buy, a hotel property or a multifamily property that's 30 or 50, 100 times larger than what I just sold. Is that a correct statement, I guess?
Well, absolutely. When you say a duplex, I mean, that's a very typical type of investor that we see. Maybe someone bought a duplex, they bought a fourplex 30 years ago for $200,000. Now it's worth $1 million because they've had it for decades, and it's appreciated. They're out there, maybe it's a couple and they're 75 years old, and they're just tired of all the work of managing it and trying to find good tenants and doing the repairs, and probably at the age they shouldn't be climbing ladders anymore. But they want to they want to get out of that. They're afraid they sell. They're going to have to give a big chunk of their nest egg to the government, and because they're retired and they don't they're not working day jobs anymore, they don't want to give a bunch of that up. They're thinking about how do I preserve that for their kids and grandkids. So when you go to a DST, the investment size is completely flexible. The minimums are typically as low as $100,000. So if you have exactly $1 million from the sale of your fourplex, your duplex, you can invest the exact dollar amount into a DST to defer all the taxes. And also with a low minimum investment amount, you can invest in multiple DSTs to have diversification, which makes a lot of sense versus putting all of your investment into just one single DST. So with the minimum low $100,000, you could do, I guess, technically you could do 10 DSTs with $1 million. Is probably a lot of not management from just oversight and all the state tax filings. Maybe you're going to invest in 3 or 4 DSTs with that $1 million and different asset classes, different geographies. But yeah, it works just so well for the investor that's really ready to go from active to passive based on age, health, lifestyle choices. It's not a great investment if you're, from the standpoint, if you're 30 years old and you're trying to hit home runs with every real estate deal. Probably not for you, but if you're the point looking passive, looking just invest in stabilized, high quality assets, core assets, or I would think of them as being more of a single or double versus a home run. They're not properties that are broken, need fixed. They're just highly stabilized assets in great markets.
So, Tim, just moving on to QOZs, this is one area that I feel like a lot of investors don't realize, because you don't have to be invested in real estate necessarily to take advantage of qualified opportunity zones. So you can sell any type of property, or you could sell really anything, any type of business, property, investment. You could sell, I guess, technically artwork, anything that creates a gain, and effectively you can, effectively invest that gain into a qualified opportunity zone. And I'll let you sort of walk through why that's beneficial from a tax perspective.
Sure. Yeah, and I think most people haven't heard about it just because it's so much newer. 1031s have been around forever. That goes back almost over 100 years in the tax code versus OZs came out of the Tax Cuts and Jobs Act of 2017. Took a couple of years for the IRS and Treasury to create their rules and regs. So it wasn't really kind of 2019 that this really got launched. But as you said, it's any type of gain, short-term, long-term, sale of any asset. And that's in contrast to 1031. A 1031 is only investment real estate. That's it, nothing else. And OZ works for any type of gain. And you only have to reinvest the gain, which is also different than a 1031. In a 1031, you have to reinvest all your proceeds to defer all taxes. So going back to that couple that sold their duplex or fourplex for $1 million, they have to reinvest all that money to defer all taxes. OZs are different. It's just only your gain. So if you sold a property for $1 million and your basis was $800,000, you could just reinvest the $200,000 into the OZ, and the other $800,000 goes into your pocket tax free. So that's a major difference, and something. And if you're selling real estate and looking at should I do a 1031 versus doing a QOZ, I would look at your basis first. If you have a high basis, the QOZ may make a lot more sense than doing a 1031. Now, it's a temporary tax deferral. It's not a permanent tax deferral. From the standpoint is there's hard and fast dates of when that tax liability is going to be recognized. And so under we'll call QOZ 1.0, which is from the 2017 law, your gain was deferred until December 31st, 2026, which is obviously very close to now. If you invested in an OZ back in 2019, 2020, you had a much longer period for deferral. Now you're down to less than 9. Well, let's call it a year because it's recognized end of this year. You're going to pay taxes April 15th, 2027. QOZ 2.0, which came because the original OZ legislation was temporary. Under the One Big Beautiful Bill, it's now permanent, and now you have and it starts in January 1st, 2027. And it's a rolling 5-year deferral period. So anytime after, anytime starting next year and forward, if you invest in you have the gain, you invest in opportunity zone, you have 5 years before you have to recognize that gain and pay the taxes. It's just a rolling, so it doesn't have a hard, fast and date like we do under 1.0. Now, there's even this year could still make sense, even with such a short deferral, because there's a couple things that most sponsors like Peachtree will do to try to help you minimize the tax liability, minimize that tax burden. One is you can do a cash out refi. So opportunity zone projects are almost always ground up development projects, and they really need to be because of the ways the rules and regs are written. And so we'll build a project in a QOZ fund structure. After it's completed, we'll take out the construction loan with permanent financing at a higher amount than our construction loan and give proceeds back to the investors to help them with that tax liability. That's number one. And the second is the taxes that are due, the gain that's recognized is the lesser of your original gain or the then market value of your OZ investment. And so what we'll do, and I'm sure a lot of sponsors will do as well, is that after it could be midway through construction, it could be closer to the end of this year for investors that are in 1.0, we'll have a new value put on that QOZ fund, and the value will probably be lower based on a couple of factors. If the property is halfway through construction, it's probably worth less than the fully completed asset is worth. There's discounts for illiquidity, lack of control, marketability, all those types of things. And so you may see a discount of maybe 30%, 35%, something like that. So you can reduce your tax liability by 30, 35%. Plus, hopefully have proceeds from a cash refi to pay those taxes.
And I think that is a pretty important piece, just the discounting effect, because it will be, we'll talk about it on the Roth, IRA conversion strategy as well. But effectively, you can, so you can invest a gain, and just to sort of wrap up the QOZ discussion, you could invest a gain, you sell a stock, you have $100,000 of gain, and that's just the gain portion. It's not, maybe you invested $500,000, you created a $100,000 gain. You could just take the gain, invest it into a QOZ, and defer out paying taxes. Effectively, you can delay it out for a period of time. When you have to pay the tax, there's going to be a valuation done on the underlying investment or fund you invested into. And the maximum tax you're going to pay at that point in time is going to be on what is going to be based on the dollar figure you originally invested. Is going to be the maximum amount, but then it's going to be, or the actual value of the investment has technically dropped. You're going to pay tax based on that lower dollar amount, on the lower value amount, which when you invest into partnerships, potentially there's a partnership discount because it becomes a passive investment theoretically. And possibly there's a discount based on, with maybe some loss of value short term on the real estate, depending on where you sit in the value creation cycles. QOZs, you potentially could invest where you get some benefit there. But the real benefit of QOZs, it goes back to what we talked about during bonus depreciations, is if you can get to the 10-year period, 100% of the new gain is tax-free for the investor.
Yes, it is. And in fact, it's more than even that. There's no depreciation recapture after a 10-year period. So if you invest in a Peachtree project, it's a ground-up development, it's a hotel that has a lot of depreciation, a lot of bonus depreciation, ongoing depreciation to offset your income. If it was not an OZ structure, you'd have a big tax bill because of recapture sometime down the road. But in an OZ, no recapture tax, no capital gains tax after that 10-year period. And so that's why you'd say, hey, it's not a long-term deferral for taxes. I'm going to have to pay some taxes. Either, if you're investing now, it's going to be April next year. If you invest, starting next year, you'll have 5 years to defer it. Making that long-term growth in what's basically what is a tax-free vehicle at that point in time. It's an incredibly powerful tool.
So let's talk about IRAs, and Roth IRAs, traditional IRAs. So you have a traditional IRA. Technically, if you have a 401k, you work for a company, you leave after 30 years, you convert it to an IRA, right? Is that how it works?
I think a lot of people that have some larger balance in their IRA came from a 401k. You're right. They left the employer, then instead of leaving it in the employer program, you rolled it over into your own self-directed IRA. You have unlimited investment choices versus the few choices you may have in that company's plan. And look at that. So looking at regular IRA, the money goes in before you pay any taxes, and it grows. But then when you take the money out in the future, it's taxable at that point in time. A Roth IRA is the exact opposite, where you're contributing after tax dollars. You're gonna have income, pay tax on the income, and then you're gonna contribute to a Roth IRA. It grows tax free, and there's no taxes on distributions. There's no RMDs. There's no tax for your heirs. So it's a great way to build a nest egg for your retirement that has no taxes, no tax implications for the future. And so if tax rates go through the roof in the future, it won't matter if you're in a Roth IRA. You're going to be taking those distributions out tax free. The problem with a Roth is that you're very limited in being able to build a lot of wealth from a Roth if you're just starting from scratch. There's limits to how much you can contribute a year, and so the typical standard limit is $7,500 a year. If you're age 50 plus, it's 8,600. There's a catch up there. And that works great if you're starting out when you're 20 years old. You put in the max every year, and by the time you're 65, you probably have $3 million based on your investment return. But if you're 40 or 50 years old, 60 years old, and you're starting out with a Roth, putting in 70 grand a year, there's just not enough time for it to grow to a large balance. And there's income phase out. So if you make more than $100,000 as an individual, you cannot contribute to a Roth. If you make more than $252,000 as a couple filing a joint return, you're phased out. And so, it's a powerful tool. It may not be helpful for a lot of people unless you do what's called a backdoor conversion, which is complete allowed under the IRS rules and regs. And under a Roth conversion, you take money that's in your traditional IRA, you can convert that. You can basically transfer it. I shouldn't say not all of it. It's all or some. You can transfer or convert any portion of that to your Roth IRA. Now you'll pay taxes on the amount that you transfer, the amount that you converted. You'll get a 1099 from your custodian at the end of the year, and so that'll be taxed at ordinary income tax rates. But now that money's in your Roth IRA, and it's going to grow tax free and have no future taxes on it whatsoever. And so that's one great way to be able to get large chunks of dollars into a Roth IRA that you can't from just doing your normal standard annual contributions.
So once you convert from the traditional to the Roth, 100% of the new gain, or any gains or any income you receive going forward is tax free.
That's correct.
So it's hugely beneficial to the investor, because if the investor invests in a project that generates, like hypothetically, using that $100 million hotel project we utilized before, and you happen to invest $1 million into that, of the 30 million of equity. So you happen to invest $1 million of equity into it, and it came from your Roth IRA. Theoretically, whatever gain that's going to grow tax free to you as the investor. So you're going to get the benefit of it, and you can pull that money out at any given time tax free. Is that correct?
Correct. Except for if you're pulling out before age 59 and a half, you may pay a penalty, but after that, there are no taxes on withdrawals from your Roth IRA.
Assume I have a traditional IRA that's got $1 million in it. I could technically invest. I could do a self-directed IRA where I could actually, I could invest into real estate, right? Like technically, I can invest into alternative investments in my IRA if I have the right, third party that's overseeing it. Correct?
Correct. That's correct.
Yeah. Theoretically, I can invest into a development of any type of commercial real estate, and when I invest into it, I could invest into that project. Using that $30 million of equity, I could invest $250,000 in this example, and at the end of the year, the investment would be valued because I made the investment from my IRA. I could turn around and do I convert it into a Roth IRA, or when do I get it valued relative to converting to a Roth IRA, or how does that work?
Sure. Yeah. So you'd want the new value, or the revaluation to be done before you did the conversion. Let's say just use it instead of using 250, let's use 100,000 just to have easier math. And so I could invest $100,000 into a development project in my traditional IRA. It has to be a project too where the sponsor, like Peachtree, is going to has a plan to do a revaluation, because not everyone has a plan to do that. A lot of our projects now, that's where we have plans to do, and so we'd have a new value put on it, new appraisal put on it, midway through construction, and that value will be lower. Maybe by 30 to 40%. Now we don't pick the value. We use an outside independent appraisal firm that will come up with a new value. So maybe that $100,000 that you invested is now valued at $60,000. So now that's the time you want to do your conversion at the $60,000 valuation. So now you're going to pay taxes on $60,000 versus paying taxes on $100,000. So it makes that conversion and getting those dollars into your Roth IRA much more tax efficient. You're still going to pay taxes, but you can pay a lot less taxes by investing in a development project. And so there's not many types of asset classes that or projects that work like that, but commercial real estate works extremely well for doing a Roth conversion. I've done it personally myself, and it's a great way to grow your Roth IRA and minimize the taxes while you're doing that.
So just to make it very simple for someone to understand, using Tim's example, you invest $100,000 into a new development project, like using that $100 million hypothetical project, $30 million of equity, you're a $100,000 investor in it, you invest it through your IRA, you get the value discount. If you didn't do the value discount when you converted it to the Roth IRA, you're going to pay tax that's going to be effectively the highest tax bracket on the $100,000. In the case of this, by investing and it gets revalued, assuming again, we don't choose the appraisals or the values, but assuming it's a 30 to 40% discount. If it's a 40% discount, you're paying tax based on 60,000 versus paying tax on 100,000. So you reduce your tax bill on the front end, and then assuming you invested in a really good project that produces great returns, all of that is coming back to you growing tax free, and with the age limits that Tim talked about earlier. So it is very powerful compounding returns on your investment. But I'm going to turn it over to Dan to talk about private placement life insurance and how you can invest very efficiently into alternative investments using private placement life insurance. So this is probably one of the more interesting strategies that isn't as known. And so Dan, I'll let you jump in, give a quick introduction, and explain exactly what PPLI is and why investors should be considering it.
Wonderful. Appreciate the time. Before I get in, just a quick background. Dan Bergan. I work for a company here called Higginbotham. It's a nationwide firm primarily focused on property and casualty. However, my role is to partner strategically with folks like Peachtree to offer this program called Private Placement Life Insurance. The acronym here, as Greg mentioned, is PPLI. At a very, very high level, just to set the stage, life insurance is utilized historically in two major ways, at least from an ultra high net worth perspective. The first is to combat estate taxes, which usually looks from a product solution at creating a very large death benefit and funding it to its minimal form. The other way life insurance is utilized is by implementing a heavy premium and a low death benefit in order to take advantage of the tax benefits inside of life insurance. For those deep inside of planning and the tax code, the life insurance tax code IRC 7702, that's what enables for cash on an after-tax basis to be contributed to a life insurance vehicle whereby cash will grow tax deferred. And then if accessed appropriately through a policy loan, we get access to all of our principal and all of our gain completely and 100% tax free. In fact, it's not even a reportable event. So today's topic is going to be around using a life insurance structure to create a tax-free pocket of income. And we refer to this as structural alpha. Because if we're doing this correctly, the investments don't change, our risk tolerance doesn't change. The only thing that changes at the end of the year is the tax bill that we write to Uncle Sam. So this discussion here today is where ultra high net worth clients, investors, and their money managers meet and link up with life insurance professionals solely in the name of minimizing and most frequently eliminating Uncle Sam from the equation. So this is a variable universal life insurance policy. It's for accredited and qualified investors only. It does what everyone hoped life insurance would do. Said a different way, it removes all of the bad things from a traditional or retail product and enhances all of the good things. What do I mean by that? For anybody that's explored a traditional or a retail policy in the past, you may have seen very large and long surrender charges, whereby if I'm contributing, let's say, $1 million over a 10-year time period, it's not until year 10 or 11 until I have $1 million accessible in my plan. In the private placement programs, there are no surrender charges. So $1 million contribution, you'll have $1 million accessible in cash value in year one. The next thing we've done, we've severely compressed fees and commissions. All in, this tax wrapper should cost somewhere between 1 and 1.5%. And that includes my fees, investment managers' fees, costs of insurance, all the nitty gritty details. The most important thing we've done here is we've gotten rid of what I will refer to as generic or bland investment choices, and the world is now our oyster. You are seeing companies left and right in the money management space hop into this as an attractive offering to their clients in an effort, again, to create structural alpha. So at a very high level, it's a structure that's utilized to escape all income and estate taxes. We're talking dividends, portfolio turnover, all the like, since it's held within this life insurance wrapper.
That is very powerful. I mean, just the ability to be able to invest, and especially in investments that tend to be not as tax efficient, like credit, for instance. That tends to this tends to be a really good way. We've seen a lot of investors utilize this for credit investments, PPLI, and that's how I was introduced to it. And it's super interesting. I mean, is there any examples of some examples you could share, just how you've seen other investors that you work with? Because I know, Dan, you work with a lot of family offices, high net worth individuals, and with probably different RIAs that manage capital for a lot of family offices and high net worth investors. So it'd be interesting if you could give maybe some examples of how people have saved significant money through these through strategy.
Yeah, I'd be happy to. So there's really two major applications, and then maybe I'll highlight, what to look for out there. But the first is going to be personally owned. So these are clients that are typically below the federal exemption threshold of $30 million that are looking and still in the accumulation phase, that want to make contributions that allow for them to create a Roth-like instrument, right? We're going to use post-tax dollars. We're going to grow everything tax deferred, and then we're going to take our income out on a tax-free basis. Just to give a generic example there, minimum contribution to these programs is $2 million. That can be done upfront or over a 7-year time period. Let's say I were to take $2 million, grow that over the course of, let's just call it 10 years. And I was very fortunate and successful in doing so. I grew my $2 million out to $10 million. I then retire and begin taking distributions with the goal of leaving just enough cash there to die with. So my 2 million grows to 10 million. I spend it down to $500,000 and pass away. Since this is life insurance, the loan is forgiven, and the remaining $500,000 in this example gets paid out income and estate tax free to my beneficiaries. Translation, I just saved income tax on $8 million worth of gain. The other major application here for those that are above the federal exemption amount of 30 million and doing significant planning, oftentimes we will find clients looking to move assets outside of their estate into an irrevocable trust. Good news, bad news there. The good news is it escapes us from all future taxation, and oftentimes we can take discounts on the assets that we're gifting away. The bad news is the government knows what we're doing in trying to shield our assets. So the tax system inside of an irrevocable trust is very unlike and very unfavorable, I would add, when compared to an individual tax bracket. Said a different way, anything over $16,500 worth of income is immediately taxed at the highest tax bracket. Therefore, we oftentimes will see clients that have large irrevocable trust positions utilize this as a tax blocker on a long-term basis, given that these assets are typically earmarked for future generations 20, 30, even 50 years down the road. Let's say we looked at a $10 million initial contribution over a 30-year time period, and let's just say we grow these assets at 9%. If I were to continue these assets inside of the taxable world and pay a tax roughly blended rate of approximately 33%, at the end of 30 years, I got about 50 million bucks. If I do this exact same contribution, exact same returns over the same 30-year time period inside of this PPLI structure, I have over $130 million. The amplification of removing tax over a long period of time, I think would surprise people when they put numbers to paper. And as long as the cost of the wrapper itself is right around 1 to 1.5%, as I mentioned, this becomes a real needle mover for high net worth clients.
Yeah. It's, I mean, that is powerful. I mean, when I didn't realize it was that big of a differential between investing without having tax efficiency with PPLI, the 10 million to 50 million versus if you invested 10 million utilizing PPLI and being tax efficient, you can get over 30 years, you can grow your, assuming you're getting that return you stated. I think you said it was at a 9% return rate, or what was the return rate?
Yep.
You assumed
9%. Yep.
Yeah, 9%. So assuming a 9% return rate, which is very achievable when you think about investing through public markets, investing in bonds, alternative investments, when you blend it all together, 9% is very achievable over a 30-year period. The 10 million grows into 130 million through that tax efficiency versus only being 50 million. That is a huge compounder to net worth. I mean, that's something that everyone should take a look at if you're, if you have interest. I just want to say thank you to everyone that participated today and listened to this. Isaac and Ari, thank you. Hopefully everyone was able to get some knowledge on ways to be more tax efficient. And again, appreciate y'all's time.
That's it for this episode of Peachtree Point of View. If you found value in the conversation, hit subscribe and share it with your network. For more insights, visit us at peachtreegroup.com. And until next time, keep crushing it.